A veteran can spend years carefully reviewing every letter from the VA and still miss one of the most valuable benefits connected to that disability rating. And the reason is simple. The benefit may not come from the VA. It may come from the county tax office. Across the country, states and local governments offer property tax exemptions, reductions, freezes, credits, and deferrals for qualifying veterans. But these programs are not automatically connected to your VA compensation. Receiving a disability rating does not necessarily cause your county assessor to reduce your bill. In many places, you must ask for the benefit, provide the correct VA documentation, and meet a local filing deadline. Here is the first thing to do. Call the office listed on your property tax assessment and ask, do you offer a veteran, disabled veteran, surviving spouse, senior, or disability-related property tax benefit for my primary residence? Do not ask only about a 100% disabled veteran exemption. That question is too narrow. Some programs begin below 100%. Some depend on when you served. Some have nothing to do with a VA rating. And some local benefits can be more valuable than the state program people talk about online. Today, I'm going to show you 6 different property tax doors veterans should check, why a veteran with a lower rating may still qualify, and how to avoid the mistake that causes homeowners to miss an entire tax year. The first question is this: does your state provide a partial exemption for a disability rating below 100%? A lot of veterans assume property tax relief is reserved for veterans rated permanent and total. That is not true everywhere. Florida, for example, provides a property tax benefit for certain veterans with a service-connected disability rating of 10% or more. Oregon has a program for qualifying veterans certified with disabilities of 40% or more. Texas provides partial disabled veteran exemptions with amounts connected to the veteran's disability rating. Those programs do not all work the same way. One may subtract a fixed amount from assessed value. Another may exempt a portion of the property. Another may include income, residency, ownership, or service requirements. A reduction in assessed value also does not mean you receive that amount as cash. Suppose your state exempts $10,000 of assessed value. That does not put $10,000 in your pocket. It means the applicable tax rate is calculated on a smaller taxable value. Your actual savings depend on local rates and which taxing authorities recognize the exemption. But a smaller benefit is not the same as a worthless benefit. If an exemption saves several $100s every year, and you remain in the home for 15 years, the cumulative value can become substantial. So do not disqualify yourself because your VA rating is 10%, 30%, 40%, or 60%. Ask where your state's eligibility begins. The second question is whether your rating opens the door to a total or much larger homestead exemption. This is where the rules become more valuable and more state-specific. Texas provides a total residence homestead property tax exemption for a qualifying veteran receiving compensation at the 100% rate because of a service-connected disability. Its rule can also include a veteran rated individually unemployable and compensated at the 100% rate. That detail matters. A veteran receiving total disability based on individual unemployability may assume, my underlying combined rating is not 100%, so this benefit cannot apply to me. In Texas, the official rule specifically addresses individual unemployability. Virginia exempts the qualifying principal residence of certain veterans determined to have a 100% service-connected, permanent, and total disability. California's disabled veteran exemption can apply to qualifying veterans rated 100% disabled or compensated at the 100% rate due to unemployability. but California generally exempts a specified amount of assessed value rather than automatically erasing every charge on the bill. That is why the phrase 100% exemption can be misleading. It may mean 100% of qualifying property taxes in one state and a specified exemption amount in another. You must also separate regular property tax from special assessments, direct levies, utility charges, and other items appearing on the same bill. California explicitly warns that its disabled veteran exemption does not apply to every direct levy or special assessment. The correct question is not simply, "Am I exempt?" Ask, "Which part of my bill does this exemption remove, and which charges remain?" I have some really good news. Abundant Years has introduced a new service called the Personal Benefits Action Kit. This is not another general checklist that gives every veteran the same information. You tell us a little about your situation, and we prepare a personal guide based on your answers, showing which benefits and assistance programs may be worth checking first. Depending on your situation, it may cover veteran benefits, property tax relief, Medicare savings, Social Security, IRS tax credits, transportation, caregiver support, and programs available in your state. Every program receives a priority score. We explain why it may apply, what still needs to be confirmed, who to contact, which documents to gather, and what to ask when you call. You also receive official contact information and a clear 30-day action plan. It is your personal roadmap, so you no longer have to watch hundreds of videos trying to determine where to begin. For the next 6 weeks, the introductory price is $44.99. You will find the link in the description. The third question is whether your military service can qualify you even without a high VA disability rating. This is one of the largest gaps in the usual discussion. Not every veteran property tax benefit is built around permanent and total disability. New York has 3 different veteran property tax exemption structures: the Alternative Veterans Exemption, the Cold War Veterans Exemption, and the Eligible Funds Exemption. The Alternative Veterans Exemption can apply to qualifying wartime or expeditionary service. The Cold War program can provide a reduction for qualifying service during the Cold War period, with an additional disability component in some cases. The Eligible Funds program follows a different set of rules connected to how the property was acquired. But there is an important catch: local participation matters. A county, city, town, village, or school district may choose whether to offer particular veteran exemptions. That means 2 veterans with similar service records could receive different results because they live in different taxing jurisdictions. Iowa provides another example. Its veteran property tax benefit is connected to qualifying military service rather than requiring every applicant to have a 100% disability rating. This is why searching only for 100% disabled veteran property tax exemption can hide programs built around service dates, wartime service, expeditionary medals, former prisoner of war status, specific injuries, or other eligibility categories. Bring your DD 214 into this conversation, not just your VA rating letter. Ask the assessor whether your service period creates an exemption separate from the disabled veteran program. The fourth question is whether the veteran exemption should be compared with another exemption available to the same homeowner. A veteran may qualify under more than one category. You might qualify as a veteran, a disabled veteran, a homeowner over 65, a person with a disability, or a homeowner below a local income limit. You may also live in a jurisdiction offering a general homestead exemption, assessment cap, tax freeze, circuit breaker credit, or deferral. The mistake is assuming these benefits always stack. Sometimes they do. Sometimes only particular portions can be combined. Sometimes you must choose one program over another for the same taxing purpose. California, for example, generally does not allow a homeowner's exemption and a disabled veteran's exemption on the same residence at the same time. New York's rules can produce different combinations depending on the exemption and taxing authority. Texas has several homestead categories, but the interaction depends on the homeowner and the taxing unit. So do not file the first form someone hands you without asking for a comparison. Say, I may qualify under the veteran, disability, age, income, and homestead categories. Which exemptions can be combined, and which option produces the largest legal reduction? Also ask whether a tax freeze or deferral is available. A freeze may limit certain future increases. A deferral generally postpones tax rather than eliminating it, and deferred balances may accrue interest or become due after the home is sold or the owner dies. A lower bill today can have a future cost. Make sure you know whether you are receiving an exemption, credit, freeze, or deferral. Those words are not interchangeable. The fifth question is whether a surviving spouse can continue or independently receive the benefit. This may be the most important section to share with your family. Numerous states extend certain veteran property tax protections to qualifying surviving spouses, but the conditions can be strict. Texas can extend its total disabled veteran homestead exemption to a qualifying surviving spouse if requirements are met. Those conditions include rules involving remarriage, residence, and whether the property remained the spouse's homestead. Oregon also provides a property tax exemption path for certain surviving spouses or registered domestic partners of veterans. California permits an unmarried surviving spouse of a qualifying disabled veteran to claim its disabled veteran's exemption when the requirements are satisfied. But surviving spouse eligibility is not something a family should try to reconstruct months after a death with no records. Keep the veteran's VA award letter, DD-214, property deed, current exemption approval, marriage record, and property tax statements together. Make sure the spouse knows the name of the county office administering the exemption. Also ask what happens if the spouse moves. Some jurisdictions may allow a qualifying surviving spouse to transfer or continue a benefit under specific conditions. Others tie the exemption to the same residence. Remarriage may affect eligibility in many programs. Do not rely on the county to contact the family and explain every option. Ask now, if the veteran dies first, what must the surviving spouse file? What is the deadline? And does the benefit remain if the spouse purchases another home? Write down the answer while both spouses can review it. The sixth question is whether a new rating, retroactive rating, home purchase, or move gives you another filing opportunity. Property tax benefits often run on local calendars, not the VA's calendar. The VA might issue a decision in September, with an effective date reaching back months or years. Your county may use a January lien date, a spring filing deadline, or a rule based on when the disability rating became effective. That does not automatically mean the county will refund every prior tax payment. It also does not mean retroactive relief is impossible. California provides procedures addressing retroactive disability ratings and filing dates. Virginia has recognized that a qualifying exemption may begin from the date of the disability rating under its applicable rule. Other jurisdictions impose their own limits on corrections, refunds, late filings, and prior year relief. Ask 4 separate questions. Can I file after the normal deadline? Can the exemption apply from the date of my VA rating? Can a prior tax bill be corrected? If I moved, must I submit a completely new application? Never assume an exemption follows you from one property to another. A veteran who sells a home, moves counties, changes ownership through a trust, or purchases a new primary residence may need to reapply. The same is true after a change in marital status or ownership percentage. The most expensive mistake may not be failing to qualify. It may be qualifying but missing the local deadline because you expected the VA and county systems to communicate. Now let's turn these 6 questions into one short action plan. First, find the office responsible for your property assessment. Depending on where you live, it may be called the county assessor, property appraiser, appraisal district, tax assessor, or Department of Revenue. Second, collect your VA Disability Award Letter, DD-214, deed, identification, latest property tax bill, proof that the home is your primary residence, and any income documents required by a means-tested program. Third, ask for every category, not just the 100% disabled veteran exemption. Ask about partial disability rating relief, total exemptions, service era exemptions, surviving spouse benefits, regular homestead relief, age-based programs, disability programs, income-based reductions, freezes, credits, and deferrals. Fourth, ask which programs can be combined. Fifth, request the exact filing deadline and ask whether late or retroactive filing is available. Sixth, ask what must be filed again after a move, new rating, marriage change, death of a spouse, or change in ownership. And finally, obtain written confirmation when the exemption is approved. Then inspect the next tax bill. An approved application does not help if the exemption was entered incorrectly, applied to the wrong parcel, or omitted from one taxing authority. Your VA rating may determine your monthly compensation, but it may also open a completely separate door at the state or county level. The VA cannot file a local property tax application for every veteran. Your mortgage company may continue collecting escrow based on the old bill until the tax record changes, and your county may have no reason to know that the VA increased your rating. That final step belongs to you. Do not begin by asking whether veterans pay property tax in your state. The answer is usually too broad. Ask which of the 6 doors applies to your home, your service, your rating, your age, your income, and your family. One correct question at the county office could change what you pay every year you remain in that house.